Today, I want to talk about how the shorts and their systems are about to fail on a massive level. The shorts lost $3 billion yesterday alone on NVDA and more on Carvana today, and soon their systems will begin breaking. So stay tuned and let's make some money. So I want to dive straight in with the key information. So, kohrs from S3 Partners tweeted saying NVIDIA short interest is $18.3 billion. As of yesterday, 27.12 million shares were shorted. Yesterday alone, there was 2.29 million new NVIDIA shares shorted worth $1.4 billion. So far, the shorts are down $2.15 billion in mark-to-market losses yesterday in the pre-market, totaling $3 billion yesterday alone. Year-to-date losses on NVIDIA alone for the shorts are now approaching $8 billion when this number is updated for the whopping 16% move yesterday. And as I said, the shorts are also down massively on Carvana. Carvana was a stock back in 2023 that traded around $6 and around $4 at one point. Now pushed up, pulled back a bit through October, November and December, and has just hit new 52-week highs over $70 per share. These shorts were shorting last year where all this volume is at $4, $6, $8 and $10 per share. Now Carvana sits at $70 per share and the shorts are massively underwater. Remember, some of the shorts' largest short positions in this market is on Apple, NVIDIA, Tesla, Carvana, Coinbase, Affirm and many others. And obviously for those shorts shorting at $4, $6, $8 and $10, well, they must be pretty close to going bankrupt. And again, those shorts that were shorting NVIDIA at $200, $300 and $400 per share have lost tens of billions of dollars. And these are the shorts that will soon start to fail, and their systems will soon start to go haywire, causing a massive hedge fund collapse. This is exactly what's currently going on over in China, as Chinese quantitative hedge funds are admitting to unprecedented failures by their stock trading models. One hedge fund manager in China described the current market as the industry's biggest black swan event. So to explain exactly what's going on here, the Chinese market is going haywire, especially now that short selling has been outright banned. And these hedge funds and their trading models, their trading systems and their algorithms are going absolutely haywire and their systems are failing. This is causing the biggest black swan event Chinese hedge funds have ever seen, causing these hedge funds to either dump tons and tons of shares or close out of tons and tons of short positions. You can see here it says Quant models went haywire as Chinese stocks crashed and rallied, and trading models failed after the market shifts. I also wanted to go through today's fast-moving momentum news play on AXTI, which ran over 40%. You can see in the pre-market set at the open, I'll be watching AXTI for the pushback towards $3.56 and for the breakout. And you can see from the open, the price ripped immediately upwards, getting that $3.56 breakout and continuing to run all the way to $4.84. Now, on top of that, many in the group like Chad have also been having great success with options, which I teach in the educational videos. Chad made 87% profit on an AMD call option, making $4,000 in one singular day. So guys, be sure to join the Millionaire Mindset Trading Group using the link in the description below, where there's a 100% guaranteed refund if the educational videos and trade ideas don't help you make a singular profitable trade within 30 days. And you can see, as Kristen has tweeted, $360 million in shares were dumped within a minute, putting a quant hedge fund in the center of the financial storm. So this article says a popular strategy for these model-driven funds involves buying small-cap stocks, which is seen as more prone to mispricing relative to their underlying value, and therefore more profitable for computer programs to exploit. And to hedge their broad market exposure, the funds would also short sell index futures such as the CSI 500 index. But the trouble for that strategy, with leverage ratios sometimes reaching more than 3 to 1, started to emerge in early February as equities tumbled. And it says as the futures tumbled and volatility skyrocketed, so did those hedging costs for the quant funds, and that's why they in an emergency dumped all these shares. So you can see that when volatility is elevated and when things start going crazy, these hedge funds and these quants end up panicking and their systems and their models literally fail. This is exactly what got that Chinese hedge fund into trouble, which I spoke about in my other video where they were just suspended from the Chinese stock market. And these exact same failing models is exactly what will happen in US markets when these short sellers start to fail. When they do reach the cap of their losses from shorting NVDA, which they seem to still be adding to their short position, all of a sudden at some point their systems will collapse. And obviously at that point, the AMC chart will look very similar to the SMCI chart going directly vertically upwards over $1,000 per share. Now, Dave Lauer has also asked, saying XRT has been on the threshold list on and off for 15 years straight. Why? Well, he said in stock lending, hard to borrow stocks that are part of a basket of stocks can have synthetic shorts created. You synthetically short the hard to borrow stock by shorting the ETF, and you buy the rest of the stocks in the basket. And that's why ETFs like XRT might or likely are hiding naked shorts on stocks like GameStop and AMC. We know XRT has something like 2,000% of all ETF shares shorted, and it's been on the threshold list on and off for the last 15 years. XRT and these ETFs is something I covered a long time ago back in 2021 in multiple different videos. A quick explainer for those that don't understand how this works: with an ETF you can short it as much as you like because the shorted shares aren't tracked or monitored as much. That's why 2,000% of the XRT float is shorted. So you short that ETF using synthetic shares and it pushes all of the stocks inside that ETF downwards. You buy the other stocks that you don't plan on crushing, pushing those stocks upwards, which again further pushes the remaining stocks that you haven't bought in that ETF down further. So that's how they're effectively shorting GameStop and AMC with an extra 2,000% of XRT shares. Again, for the proof on that, right now XRT currently has 319% of the ETF shares shorted, so 3 times the float. And at its highest, this has been up to 2,000% of shares shorted, so 20 times the float. And as Hang Loose has added, he said if market makers use the reasonable locate exemption and the transaction ends up as an FTD, then surely that's clear evidence and proof that they lied about their locates or the ability to locate shares. Saying there is a word for that, and it's called fraud. Using a reasonable locate exemption when you have full knowledge that you cannot locate shares surely is not right. And they have full knowledge they clearly cannot locate shares if 300% of the float is shorted, specifically for XRT, and obviously results in an FTD. But yet they still continue to do it day in and day out because there's no punishment. And that's why we, the investors, has tweeted saying 2024 is key, saying we're ramping up efforts at the SEC and at Congress too, to create true FTD transparency, to close regulation SHO loopholes, and to adopt an FTD settlement discipline regime with mandatory buy-ins and escalating fees and punishments. We the Investors is obviously the program created by Dave Lauer to fight for market transparency, and obviously to close these SHO loopholes and to adopt an FTD settlement discipline regime. And finally, Simulation Ape Nation has tweeted something really interesting, saying AMC has dropped by 99%, but yet the shorts, the hedge funds and the mainstream media still desperately needs retail to sell. He said, Jesus, how many times did they short sell the float multiple times over? There's clearly billions of shares that shouldn't exist if these shorts are still desperately begging you to sell shares. The stock price has dropped by 99% and shorts haven't closed because short interest has been increasing. And you can tell from this chart the price in yellow only dropped because the massive number of FTDs that were created back in August. Without these FTDs, FTDing a tenth of the float day after day after day, the price of AMC would have never dropped. And that just shows the shorts have doubled, tripled and quadrupled down on their short positions and have done so to try and push the price down. But by doing so, haven't covered any of their short positions and have added significantly more. And that's why, even though the price is down by 99%, the mainstream media is still desperate for you to sell. So guys, be sure to let me know what you think down in the comments below. And as always guys, be sure to ding that notification bell, because that way you'll be alerted when I upload a new video. Cheers.